I wanted to kind of provide a bit of an introduction to Bitcoin and Bitcoin mining. Some of this, for some of y'all, will be old hat, but nevertheless, I think that it's important that we are always reviewing the fundamentals. And the reason why I think it's important for this audience to go over why Bitcoin and what is Bitcoin is that if we look back at the history of Texas, if you were buying land in 1800, you probably would not want to have oil on that land, right? Because you wanted to have cattle grazing. And so oil was a nuisance in 1800. Fast forward to 1900, you certainly would want oil on that land because now society, technology has unlocked the value of that oil, and it's now more valuable than cattle. Well, I don't want to get into that controversy, but nevertheless, it just shows that with the advancement of technology, a resource can go from being a nuisance and worth $0 to being hugely valuable. And so, what I want to present is why I think that Bitcoin has utility, why it has value, and why over the past 15 years it has gone from being worthless, worth $0 in 2009, to today being worth $500 billion in terms of market cap. So I think the first question is, what problem does Bitcoin solve? And the problem Bitcoin solves is distrust in this central banking experiment that we've been going through over the past century. Now, we could frame this very politically and say, oh, they're doing all the wrong things, this is bad. I would be much more charitable and say they're doing the best they can with the technology that they have. But the reality is that we have a new technology. Just like, back in the day, we could have said, oh, horses are terrible, everything should be powered by gas. Well, yes, but that's the technology that we had. So from my perspective, Bitcoin is superseding this obsolete technology of central banking. I think it's particularly urgent to transition away from central banking for a number of different reasons. I think personally the most important one is the rise in wealth inequality. So when a certain group of individuals in society have the ability to print money out of thin air, that is mechanically going to drive up wealth inequality. And we've seen this in the statistics, and I think we've also seen it in the polarizing political discourse. There's other reasons as well, though, that the central banking system is fundamentally there to support a commercial banking system that is fractionally reserved. And as we saw earlier this year with SVB, and as we saw in 2008 with Lehman Brothers and others, there's a constant need for bailouts, right? That this banking system is inherently unstable, and that means that we're constantly having to print more money to bail them out so that they don't crash the economy. And so I think this is really the central problem that Bitcoin is solving, and giving people access to a monetary system that does not have this dilution of the currency built into its business model. So how does Bitcoin solve the trust problem? I think the three core values of Bitcoin, as I see it, are transparency, accountability, and reliability. And we're going to go through each one of those and how they work in the Bitcoin context. So Bitcoin, I think, is the most transparent system in the history of humanity. First of all, if we start with the software itself, it's all open source. You can see all of Bitcoin's code publicly available. And in fact, there's multiple different code bases. So there's lots of different software engineers who have re-implemented the Bitcoin protocol using their favorite programming language. And so this, by nature, allows anyone in the world to look at Bitcoin and find ways to improve it and to suggest improvements, or to audit the code and look for vulnerabilities, look if there's anything that can be improved from a security perspective. The second aspect of transparency is about the transactions. So all of the transactions are pseudonymously, permanently written onto the public ledger, the blockchain. And so these two elements of transparency, I think, are really unequaled throughout human history. The Federal Reserve runs on proprietary software. If you ask to see the source code for the Federal Reserve systems, they will laugh at you. They'll never show you what the source code is for how the Federal Reserve System operates. They're not going to post it on GitHub. And they're certainly not going to show you all the transactions, right? Those are very much secrets. And only the anointed auditors, right? I think it's KPMG right now that's auditing the Federal Reserve, are allowed to audit the ledger. That's not the case with Bitcoin. Anybody can audit the Bitcoin ledger, and anybody can see what is the Bitcoin supply. And that leads us to accountability, which is that the way that you audit Bitcoin supply is using node software, right? So this open source software, you can run it on your computer, you can run it on your laptop, your desktop, your server. And that's what's going to allow you to look at the entire history of Bitcoin's ledger, which is about 600 gigabytes, and verify that no Bitcoin has been added to the ledger in a way that is fraudulent, right? Beyond what has been agreed to. In terms of accountability, this is really it cuts both ways, right? With tremendous freedom comes tremendous responsibility, and that means that if you want to use Bitcoin as kind of let's call it a first-class citizen, right, of not relying on anyone else, that means you have to run this software yourself. The bank isn't going to run it for you, right? Or if they do, then you have to trust them, kind of defeating the point of Bitcoin. And that's also true for actually holding the asset itself in the form of private keys, right? And that's where the saying, not your keys, not your Bitcoin, comes from, which is that if you want to be accountable for your money, if you want to control your own money, that means that you have to also hold your own keys. Now, thankfully, we have hardware wallets and other technologies that have really kind of made this much more secure and much more user-friendly. I think that there's still room for improvement in this area, but nevertheless, it is markedly differentiated from the existing fiat system where you always have somebody else holding your money, right? So if you're using Chase or Bank of America, they'll hold your money for you. Now, they won't even hold it, right? They'll go lend it out. Back to the fractional reserve problem. But in any case, you have to trust them to hold it for you. And that means that you have to ask them for permission every time you want to move it around. And that is not the case with Bitcoin. I think that the closest you could get to how Bitcoin works in the real world is with physical cash, right? $100 bills. Now, even in this case, though, the problem is that your counterparty is still the Federal Reserve, right? That can just create more $100 bills out of thin air, stack them on pallets, and fly them wherever. So you still have that risk of getting diluted. And you also have the problem of centralized custody. So with Bitcoin, you're actually able to do what's called multi-sig. So you can split up your keys into, let's say, 3 different wallets or 3 different USB devices. And then you can set up a rule that says, OK, I have to have 2 of these 3 devices. And that allows you to decentralize custody. That's impossible with dollars. It's impossible with gold, right? And with gold, what that has led to is that custody of gold has become completely centralized. The most secure way to hold gold is to put it in Fort Knox and to surround it with the US military and nuclear weapons. And that's how you're going to secure gold. With Bitcoin, the most secure way to custody Bitcoin is not to put it all in one place. It's actually to split it up using multi-sig so that the authorization can come from multiple different devices. And so the decentralization of custody is also a critical component of Bitcoin. Last but not least, reliability. So decentralization, whether it's with the Bitcoin node software or with the mining rigs, which we'll talk about later, or with private keys, this decentralization removes single points of failure. It removes piece is where you have to trust someone else, right? And that ultimately, not only does it give you more freedom, but it also makes the whole system more resilient and more reliable. And then the last point, I think this is what differentiates Bitcoin from every other cryptocurrency, which is its approach to software engineering. How is it developed? Bitcoin optimizes to have software that is as reliable as possible. And the criticism of that is that it slows down Bitcoin's development. That, oh, hey, we need to be doing innovative things with blockchain technology for Web 3.0 so that we can have our medical records on the blockchain. Bitcoin utterly rejects that approach and instead says, no, we have to have the most reliable monetary system in the history of humanity. And there's a trade-off between those two approaches that is irreconcilable. And so when we're looking at Bitcoin, it's really misleading to see BTC as a ticker symbol that you compare to ETH or to Polkadot or to Dogecoin, right? Because fundamentally, those other systems are engineered for different purposes than Bitcoin is. And so it really is comparing apples to oranges when you're looking on these exchange websites. I know because I used to work in an exchange, but won't get into that. OK. How does Bitcoin work if we go a little deeper? So I mentioned the Bitcoin nodes, the node software. And that is this big ball of dots that you see there. It's a hairy mess. And that's why Bitcoin is decentralized, is because anybody can run a Bitcoin node. And it's very low cost to run a Bitcoin node. So this allows you to verify all of the transactions are following the Bitcoin protocol's rules, and that any blocks that are proposed by Bitcoin miners follow those rules. If they don't, then you can reject those transactions, and you can reject those blocks, which are batches of transactions, in which case the miner does not get any revenue for it. Or if in the case of a transaction, the recipient does not receive the funds. And so when people talk about, oh, who controls Bitcoin? It's a paradox, because on one hand, you control Bitcoin. Just download the software, download the code, and you control Bitcoin from your perspective. But that doesn't mean that you control Bitcoin from other people's perspectives, because each user of the system is empowered to be sovereign, to actually control the system from their perspective. And so then it really raises the question of, well, if everyone's in control, then nobody's in control over that, right? There's no overarching umbrella organization with Bitcoin CEO who's telling everybody what to do with Bitcoin, right? It really is the most grassroots organic thing you could ever imagine. All right, so let's dig into the mining aspect, which I think is what we're here for. So Bitcoin mining has two purposes within the system. One is issuing new Bitcoin onto the ledger. When Satoshi Nakamoto released the software in 2009, the ledger had 0 Bitcoin on it. And then every 10 minutes after that, 50 Bitcoin got added to the ledger. 4 years later, in 2012, it got cut in half. We'll talk about that. But the purpose of having the issuance of Bitcoin go through the mining process, rather than through any other allocation process you could imagine, because Satoshi could have said, hey, look, there's only going to be 21 million Bitcoin, and they all go to my friend Jim, right? That would have been one way to bootstrap the ledger. Instead, he wanted to have the Bitcoin trickle out through this mining process. And the virtue of this is that the mining process is open. It's competitive, right? Anybody can start mining Bitcoin because all you need is a computer. In Satoshi's time, all you needed was a laptop. And things have changed a little bit there, but not that much either. And the competitive process prevents what's called monopoly seigniorage rents. So this comes from the world of monetary economics, where when the government prints a $100 bill, it costs them a penny, meaning that they get 99 $0.99 in profit from printing the $100 bill. Now, that kind of profit margin, how do they achieve that? Well, they achieve it with counterfeiting laws. If anybody tries to compete with them, go to jail. Right? So, they've got the Secret Service hunting down people who try to compete with the government for printing money. And so that's what gives them these profits of monopoly seigniorage. Now, you can imagine the equivalent in Bitcoin mining would be if the big Bitcoin miners were like, hey, we're going to stop anybody else from mining Bitcoin. That way we can boost our profit margins, right? And that's obviously not reality, and I don't think it will ever be reality because of Bitcoin's decentralized nature. The second purpose of Bitcoin mining is about ordering transactions in batches. So those blocks I was talking about. And this order is temporal. So Bitcoin mining, you can think of it like a decentralized clock, right? It is the timekeeper that ticks every 10 minutes and adds transactions to the ledger every 10 minutes. This is really important because it solves what's called the double spending problem. So the double spending problem is what happens if somebody tries to spend the same unit of money twice, right? In the traditional banking system, the bank will decide either they'll extend you credit, right? You'll get some overdraft fees, or they will decline the transaction if you don't have the balance. And so in Bitcoin, this happens in a decentralized way so that because Bitcoin's not a credit system, it's impossible for the Bitcoin network to extend you an overdraft fee. But the ordering of transactions prevents the same money from being spent twice. All right, so I mentioned earlier the new Bitcoin being added to the ledger. This is what it looks like over time. So as you can see, there is a change that happens every 4 years. So in 2012, 2016, 2020, 2024, the curve shifts. And that's because of the halvings. So the halvings, as the name implies, cuts the number of Bitcoin being added to the ledger in half. So it started at 50, then it went to 25, then 12.5, then 6.25. Next year, 2024, in April, it will go to 3.125 Bitcoin. So that'll continue until approximately the year 2140, when the last Satoshi, and a Satoshi is a fraction of a Bitcoin. So in one Bitcoin, there's 100 million Satoshis, just like in $1, there's 100 pennies. The last Satoshi will be mined in the year 2140. Okay, so that's not the only revenue the Bitcoin miners get, though, right? They also get the transaction fees. So I've layered on top here the transaction fees. So you can see in the new issuance is in gray, and then the transaction fees are in orange. Far less than the new issuance, but they're nonetheless. So what drives the transaction fees? Because transaction fees in Bitcoin have been pretty volatile throughout its history. And it really is about what's called the block size limit. I mentioned earlier what makes Bitcoin decentralized, what gives it value, is your ability to run a Bitcoin node. And one of the early threats that Satoshi saw to his vision was that running a Bitcoin node could become too expensive if we had too many transactions that needed to be processed. So before he left in 2010, Satoshi put in place what's called the block size limit, which puts a ceiling on the size of each Bitcoin block. At the time, he said 1 megabyte. So 1 megabyte every 10 minutes getting added to the ledger. That way, we can actually prevent the growth of the ledger from getting out of hand. What happens if the blocks get too big is that then the network becomes centralized. And then only Google, Facebook, Amazon, the cloud providers, they would be able to run these mega nodes that process these 1 terabyte blocks or whatever it is. And then they would set the rules for Bitcoin. That's a huge danger, right? Because obviously, if you're Tim Cook or whoever, you don't want to create more Bitcoin for yourself. So if you're in control of the ledger because it's too expensive for anybody else to run a Bitcoin node, then you're able to credit yourself some Bitcoin. So that's why Satoshi Nakamoto put in place the block size limit. Now, it's been hugely controversial because he kind of grabbed a number of 1 megabyte every 10 minutes. There's nothing in computer science that says that's the right number. There's no way to know what the right number is. So it has led to constant infighting within the community over whether to change the number or not. But nevertheless, here we are, still with a block size limit. And what happens is that when the number of transactions that are trying to get onto the ledger exceeds the limit, then they start competing against each other and trying to outbid each other to get into the next block. And that causes transaction fees to increase. Typically, this happens when there's a bull market, right? Because you have lots of speculators that are trying to arbitrage between exchanges, deposit and withdraw from their cold storage. And so that drives up transaction fees during Bitcoin bull markets. And then during the bear market, things quiet down a little bit. You still have lots of transactions, but there isn't that sense of urgency. And so transaction fees go down quite a lot. So in dollar terms, during the December 2017 bull market, a typical Bitcoin transaction could cost you $50 worth of Bitcoin. And then in the bear market, it'll be 5 cents worth of Bitcoin is what a transaction fee would be. So when you hear somebody say, oh, Bitcoin transaction fees are very low or they're very high, they're looking at it at a specific point in time. I think the more accurate statement is that Bitcoin transaction fees are volatile depending on how much demand there is on the system. Yep.
Question, what's the units on the right?
The units on the right is Satoshis per byte.
Satoshi.
Yeah.
And I'm assuming the blue is the percent utilization, the white is the
Fee rate.
Fee rate.
Mm-hmm.
Thank you.
Yep. Now, when transaction fees are high, that incentivizes users and developers to find ways to use this limited block space more efficiently. So ultimately, it does actually lead to increases in the effective throughput of the system. But the congestion pricing is just part of the growth pains. OK, so then if we look at this number, right, issuance plus fees in Bitcoin terms, this is the revenue going to Bitcoin miners. This picture on its own looks very bad, right? You basically have your top line revenue getting cut in half every 4 years. So why would anybody want to get into the Bitcoin mining space? And furthermore, why has it grown over the past 15 years, given that the Bitcoin revenue has been cut in half every 4 years? Well, because Bitcoin's value, its purchasing power, its dollar exchange rate has skyrocketed. And so when we multiply those out, what we see is that Bitcoin's annual mining industry revenue has increased, even if in dollar terms, even if in Bitcoin terms, it has decreased. And that's what this chart shows. So annualized, we're probably at about $10 billion of industry revenue annualized at this point. Any questions before I continue?
Is that
yeah.
in the U.S. or is that worldwide?
This is worldwide. So well, I like to say like Bitcoin's the native money of the internet. So I'd say anywhere there's internet, this is it's part of Bitcoin's dominion, right? So this is looking at the Bitcoin network as a whole. Now the U.S. is capturing some percentage of that, right? Yeah. All right, so that's the revenue side. It's very exciting. Let's look at the cost side. There's a really great academic paper that has been written about Bitcoin mining. And I've got the citation here on the left. If you enjoy reading academic papers, this is a high quality one. This isn't one of those gobbledygook, postmodern papers. This one actually looks at reality. And the reason why this paper is really of such high quality, I mean, other than the talent of the researchers, is their access to data. They make a point in the paper of talking about no other industry provides them this level of transparency from an industrial economics perspective to where they're able to really comprehend the dynamics of the industry in a transparent way. And what they found is that, in neoclassical economics, people talk about perfect competition. And usually that doesn't map very well to reality. What they found in this paper is that it's actually a pretty good approximation of reality. And what that means is that over the long run, so marginal revenue equals marginal cost in the long run. But then we could get into the weeds of specific industry players and what differentiates them and what enables them to have a profit margin. But in any case, at a high level, 40% of the mining revenue that we talked about, right? So we said $10 billion. So $4 billion annually, that gets spent on electricity, right? So that's revenue going to power generating assets. 60% of it gets spent on mining rigs, whether it's Bitmain, MicroBT, or any new competitors that come along. Some exciting announcements going on. Hosting, right? So real estate, the land, the buildings. Overhead, myself, I'm overhead. And cost of capital. So that's kind of how it breaks down. And I think that this is really where we see the natural fit between the energy industry and Bitcoin mining. That 40% of Bitcoin mining is essentially a pass-through to the energy industry, which is a big dollar amount. The way I'd conceptualize Bitcoin mining, it's about transforming energy into time, right? Into those 10-minute intervals that are adding transactions to the ledger by doing work, right? This is the proof of work part of Bitcoin mining. The work, how are we on time? We're good on time?
Yeah, you're good.
Okay. Let's get into what the work is. The work in Bitcoin mining is called hashing. So a hash function is a cryptographic function that allows you to take any piece of information, any message, any piece of data, you pass it through this function, and you get a fixed length random output. Now, if you pass the same information through the function, then you get the same output, so it's deterministic. But if you change the information even a little bit, even in the smallest amount, right? You flip a 0 to a 1, the output is completely different, completely randomly different. And so the output is called the hash. And the function in Bitcoin is SHA-256 squared. You actually run it twice. But this SHA-256, what that's telling you is that the output is going to be 256 zeros and ones, regardless of what the input is. So it could be a big message, a small message. The output is going to be 256 random zeros and ones. So from that, we can start talking about the difficulty adjustment. So the difficulty is how many leading zeros are the Bitcoin nodes asking the miners for in the hash that they are generating. So if the Bitcoin nodes ask for one leading zero, it doesn't take very long for a hasher, a Bitcoin miner, to find that. I actually ran this on my laptop. It took only 21 attempts to get a leading zero in a hash. And the way that you do that is to get to 21 attempts, you just have your message. Here the message is Bitcoin. And then you add some random piece of data, and you constantly change that random piece of data that you're putting into the input of the function so that the output is a fresh new hash that gives you a chance of finding enough leading zeros in that hash. Now, as you increase the difficulty, you ask for more leading zeros in the hash. It gets harder, and it requires more attempts, right? Just by the laws of probability. And so that's where we see that at the extreme here, I've asked for 7 leading zeros. It took 111 million attempts, so it took about 3 minutes. Now, when we translate that into Bitcoin mining, hardware terms, a typical S19 does 140 trillion hashes per second. So that's an astronomical number. Although now that the national debt is $33 trillion, I think we're starting to be able to reason in trillions, right? Sadly. So when you look at, now there's 400 exahashes is kind of the whole network. So if you math it out, you're basically looking at the whole Bitcoin mining network is 1 to 2 million S19s that are hashing. And the total network hash rate is now, I think, north of 400 exahash. So this is, again, an astronomical number. Hopefully the national debt does not get into X trillion dollars or whatever. Okay, so all of this is because the value of the mining reward, the transaction fees plus the new Bitcoin being added to the ledger multiplied by the exchange rate into dollars has so dramatically increased that you have lots of people competing to get those Bitcoin. And how they compete is by generating more hashes. And then the Bitcoin nodes look at this increase in the number of hashes, and then they increase the difficulty so that they're always targeting a block every 10 minutes. Okay, so now this chart looks at what's the daily dollar revenue per petahash. And so this you'll hear it referred to as hash price. Just want to introduce the terminology here very quickly. And I have this chart here. Now we're going to tie it back into energy. This is from our friends at Lancium. It's not fully up to date, but it's not completely off either. It's looking at what is the break even between the spot price of electricity and your revenue in Bitcoin terms. So meaning that if the price of electricity is over $100 a megawatt, let's say, then it's not profitable to mine Bitcoin. Instead, you should turn off. If it's less than $100 per megawatt, then it is profitable to mine Bitcoin, so you'll turn on. And so this is really hugely important when we think about how Bitcoin mining interacts with the grid. Bitcoin mining is very different from any other kind of industrial scale load. Most industrial scale loads, their break even is in the thousands of dollars per megawatt, right? Meaning that a steel mill is not going to turn off just because the price of electricity is elevated for 15 minutes, whereas a Bitcoin miner will. Bitcoin miners are uniquely price responsive to what's going on in terms of the input electricity. And this is illustrated in a great paper from our friends at Texas A&M. They looked at what is the relationship between the stress on the grid and the amount of Bitcoin mining happening. So when the grid has a lot of stress because everyone's turning on their AC, Bitcoin miners are turning off because the price of electricity in real time is higher than $100 per megawatt. And so this creates a negative correlation between the overall stress on the grid and the amount of Bitcoin mining happening at any given point in time. This is really important because we'll hear politicians talk about, oh, Bitcoin miners are bad for the grid because they're adding stress to the grid. And the reality, the data, shows that the opposite is true. The Bitcoin miners actually are filling in the the shoulder areas of electricity production and helping, in Texas, sometimes at night, the electricity price will be negative because there's too much wind. And so Bitcoin miners help absorb this excess energy. And then during the peaks, this past summer we saw a lot of peaks when it's 110 degrees outside and everyone's got their AC on, the Bitcoin miners can turn off, they can curtail and reduce the stress on the grid. There's a few different aspects to this curtailment or demand response. One is just simply avoiding high spot electricity prices by turning off. The second is that you might have a power purchase agreement in place that allows you to sell back pre-purchased electricity. And that way you're able to have a hedge so that if you need to be off, then that means you're still earning revenue from your hedge. So in terms of risk management, that can be a critical component of running a mining operation. And the third is participating in ERCOT's ancillary services, because economic curtailment means that the Bitcoin miner gets to choose when they're going to turn on or off based on the spot price of electricity. ERCOT's ancillary services are really about ERCOT's mandate to maximize reliability. They procure resources, whether it's power generators or loads, so that then they can deploy those resources when they want to, not based on what's going on with the price of electricity, but rather based on what's going on with the physical grid. Right? And that allows them to balance supply and demand on the grid to prevent blackouts and brownouts and transmission constraints and all of this kinds of grid level issues. And so Bitcoin miners are a really important way of lowering the cost of procuring ancillary services, because they can deliver those services at a lower price point than their competitors, like batteries, for example. All right, any questions? Yeah, who's hedging Bitcoin? So I mentioned hedging in terms of the electricity price, which is very volatile. It's kind of an input cost to Bitcoin mining. And then as an output revenue, you have actually selling Bitcoin. And you also have, you even have people talking about hedging hash rate, so network difficulty, right? So now, I'll just speak for myself, not for Riot. Riot, if you look through our public filings, we don't hedge our future production. And personally, my personal opinion of it is that we should not. The Bitcoin miners should not hedge their future Bitcoin production or even their hash rate. And the way I see it is that you should be able to. The reason people want to invest in Bitcoin mining is to have exposure to those future Bitcoin flows, right? And I kind of see it as Bitcoin mining is already a derivative on spot Bitcoin. That you're basically saying, hey, there's this future dollar cost averaging of Bitcoin coming in, and when you start thinking about how you want to manage your cash flow, it makes a lot of sense to sell the Bitcoin that you're mining in order to pay your operating expenses. One, all the electricity, and two, in order to reinvest and grow the business. But I think that hedging the Bitcoin itself, I'd almost argue the opposite, that you should be accumulating Bitcoin on your balance sheet, and that's what Riot has been doing. Now we've got 7,000 Bitcoin on our balance sheet for the reasons that I outlined at the beginning, right? Which is that when we look at the existing monetary system and Bitcoin's growth prospects, that it makes a lot of sense to hedge against the dollar, right? I'm more worried about the dollar collapsing than Bitcoin collapsing. So I'm more concerned about hedging against the dollar than hedging against Bitcoin, if that makes sense. All right, well, thank you so much. Thank you all for coming.